We've pushed it ahead by 18 months and then put where we are with CPI inflation on top of it. Money leads inflation. And you can see what this chart is saying. It is very likely that we are going to move into negative territory when it comes to inflation in 24 and 25. And we would not be surprised to see an overshoot here. And that will provoke a significant Fed reversal in policy.
Cathie wood explores the adverse trend in money growth, which turned negative in late 2022 and persisted throughout 2023. This trend is anticipated to result in negative inflation rates in 2024 and 2025, potentially prompting a substantial shift in Federal Reserve policy. Wood foresees a continued decrease in long-term interest rates, possibly reaching as low as 2%. This outlook is grounded in the observed correlation between the metals-to-gold price index and long-term interest rates, signaling a call for Federal Reserve easing. Addressing the political discourse on fiscal policy, Wood specifically examines the U.S. federal debt surpassing GDP for the first time in history, a situation exacerbated by the COVID-19 pandemic. She acknowledges the seriousness of the debate but suggests that, fueled by innovation driving problem-solving and turbocharging real GDP growth, the situation may not be as dire as some believe. Reflecting on historical context, Wood draws parallels to the Reaganomics era, proposing that similar supply-side policies could lead to substantial economic growth and potentially reduce the debt-to-GDP ratio.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Here is the chart that has really charged the political debate. You can see for the first time in history, our debt, our total public debt, this is federal debt, has crossed over. It did so. It was threatening to do so in the last 5 to 10 years. It did so decisively during COVID. Now, one thing about this is these are two different kinds of measures. Debt outstanding is a stock. It's an absolute number, level of debt. GDP is more of a flow. It is a measure of the goods and services produced in any year. And if we're dealing with a quarter, it's annualized. So again, any year. So different kinds of statistics. I think the debate is serious, but I don't think it is as serious as many think it is if we are right. That innovation solves problems, and we're going to go into a period, thanks to unbelievable amounts of innovation. You just heard about Bitcoin. We believe that real GDP growth is going to be turbocharged. So the 3% that we've seen on average over the last 100 years in real GDP growth, we think is going to be much higher going forward as these innovations hit critical mass, and all of them are moving into prime time. So, and then you can see on this next page what I mean. So this is public debt outstanding. So that purple line on the previous chart divided by GDP. And I do remember starting my career in the early days of the 80s. And oh my goodness, the debate was supercharged then as well. And what happened was Reaganomics or supply side policies did turbocharge growth in the 80s and 90s. And with a lag, we began to see the leveling out of this metric. We think there's going to be so much growth, so much more than even in the early 80s, that this line, debt outstanding to GDP, is going to come down fairly dramatically now that there is gridlock in Washington. And we believe that gridlock will be sustained during the next 5 to 10 years.
Considering the anticipated shift toward negative inflation, Wood implies the possibility of a significant reversal in Federal Reserve policy. This potential shift could involve implementing easing measures to counteract deflationary pressures and stimulate economic growth. Wood envisions that long-term interest rates are likely to persist in their downward trend, with the potential to reach as low as 2%. Expressing concern, She notes that the Federal Reserve's unanimous decisions in the past year may not have thoroughly taken into account the red flags raised by various economic indicators from different Federal Reserve banks. She suggests that the Fed's focus on avoiding the reputational risk of letting inflation escalate may have resulted in an oversight of these crucial indicators.
Here, the purple line is money growth. And you can see the money growth rate is negative, and it turned negative. This we've pushed money growth forward, but it turned negative at the end of 22 and was negative throughout 23. We've pushed it ahead by 18 months and then put where we are with CPI inflation on top of it. Money leads inflation. And you can see what this chart is saying. It is very likely that we are going to move into negative territory when it comes to inflation in 24 and 25. And we would not be surprised to see an overshoot here. And that will provoke a significant Fed reversal in policy. On this page, this is the yield curve. And the yield curve, the zero measure there, anything below is an inverted yield curve. And you can see we've had an inverted yield curve by this measure, which is the 10-year Treasury yield minus the 2-year Treasury yield, for 18 months, roughly. It's quite a long time, and it's reminiscent more of what went on in the late 70s, early 80s. And we ended up in 2 recessions in 1980 and 81 back then. So this would suggest that we're going into recession. The only consideration here, though, is if falling prices do ignite unit growth, meaning the unemployment rate doesn't go up too quickly, and corporations really start to understand that they can drive unit growth if they cut prices, that could be what this is signaling. We'll have to see. Right now, we do believe the higher probability is of recession. And then on this chart, just to give you a sense of the drama here, this is the number of consecutive days that the yield curve has been inverted. And you can see the 3 most serious recessions that we've had in post-World War II experience are the 73 to 75 recession, the 1980 to really, it was one big recession from 80 to 83. And then you can see where we are now. It's even more in terms of consecutive days than 08, 09. So if you were using this chart alone, you'd say, oh my goodness, what kind of recession is this going to be? Again, we've been through a rolling recession. I think that's partly what this chart is telling us. And we don't think the recession is going to be severe, but it is going to be something the Fed will have to address. Here is the Federal Reserve Bank of New York recession probability. It has been saying for quite some time that we're going into a recession. And in fact, late last year, we got to a level where we had only been in the early 80s before. So, but these votes at the Fed have been unanimous, which is kind of crazy, because each of the Federal Reserve banks has their own economist, economic department, and each one of these Federal Reserve banks, most of them, I would say, would tell you that their indicators were flashing red. And not just for the last few months, but for the last year. So I just think this Fed did not want to be saddled with letting the inflation genie out of the bottle. They didn't want that reputational risk. They were really thinking about themselves, and they weren't looking at these indicators.
The number of Americans filing new claims for jobless benefits hit a 2-month low last week, signaling underlying strength in the labor market amid easing demand for workers. The Labor Department's report on Thursday also highlighted that the number of people on unemployment rolls remained elevated at the end of December. Financial markets continued to anticipate potential interest rate cuts by the Federal Reserve starting in March. In a separate report on Wednesday, job openings fell to a near 3-year low in November. Despite the ongoing cooling of the labor market following interest rate hikes by the Federal Reserve since March 2022, the unemployment rate has stayed below 4%. Companies are retaining workers, reflecting difficulties in finding labor post-COVID-19. The current situation is viewed favorably for consumption and the overall economy. Financial markets are optimistic about potential interest rate cuts in March, as indicated in the minutes of the December policy meeting, where officials acknowledged the tightness in the labor market and signaled a shift towards lower borrowing costs in 2024. In terms of people receiving benefits after the initial week of aid, a proxy for hiring decreased to 1.85 million during the week ending December 23. Continuing claims have mostly increased since mid-September, attributed to difficulties adjusting data for seasonal fluctuations. Economists expect these distortions to be smoothed out when the government revises the data this year. The article concludes by inviting readers to share their thoughts on inflationary levels as the new year unfolds. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.